All right, today we're going to take a look at the Marushika Technology SME IPO. We're going to break down all the key details, the good, the bad, so you can get a real sense of whether this small-cap tech company is a fit for your investment strategy.
So that brings us to the real question, right? Is Marushika Technology one of those hidden gems you find in the small-cap world, or is it actually a riskier bet than it looks on paper? Well, let's dig in and find out.
Okay, let's get right into it. First things first, we've got to look at the essential numbers and dates for this public offering. This is really the foundation for everything else. So here are the core facts. The bidding window is pretty tight. It's just from February 12th to the 16th. The price band is set between 111 and 117 rupees a share. But here's the kicker you need to pay attention to. The lot size is 1,200 shares. And as you'll see in a second, that means the minimum ticket size to get in is pretty significant for this offering of just under 27 crore.
So what does that lot size mean for you, the retail investor? Well, at the top end of the price band, one single lot is going to set you back 2,66,400 rupees. Yeah, this is not a small bet. It's a pretty hefty minimum investment, which is actually quite typical for SME IPOs, and it kind of filters who can even participate from the get-go.
And this is a really important point. We're talking about an SME IPO here. That means it's going to list on a platform like NSE Emerge, which is a whole different ballgame from a main board listing. What's the difference? Well, the big ones are usually lower liquidity, meaning fewer buyers and sellers, and that can lead to much higher volatility after it lists. That's a critical risk factor you've got to keep in the back of your mind.
Okay, so we've got the IPO details down. But now, let's pull back the curtain and look at the business itself. What does Marushika Technology actually do to make its money?
When you look at what they do, it's actually a pretty wide range of stuff in the tech infrastructure space. We're talking data centers, cybersecurity, big video walls for surveillance, even some auto tech for the defense sector. But what's the common thread tying all this together? It's their heavy reliance on government and public sector unit contracts. And that is a really, really important piece of the puzzle for understanding both their strengths and their weaknesses.
And this slide right here, this really gets to the heart of their business model. Marushika is basically an integrator and a distributor. Think of them as the architects who take existing tech, the bricks and mortar from other companies, and build customized solutions for their clients. They are not a product developer. They don't have their own unique software. So their competitive advantage, their moat, isn't in some secret tech sauce. It's all about their execution and their relationships.
All right, so we know what they do, but does it make money? Is the business actually healthy? Is it growing? Let's dive into the financials because the numbers always tell a story.
And wow, okay, when you look at the numbers, they tell a pretty compelling story of growth. Just look at the revenue here. It went from 37 crores in fiscal 23, then jumped to 61 crores, and then all the way up to 85 crores in fiscal 25. I mean, they've more than doubled their total sales in just a couple of years. That's some serious upward momentum.
But top-line growth is one thing. The real question is, are they actually making a profit? And yeah, they are. In the last fiscal year, their profit after tax, the actual bottom line number, came in at around 6.3 crores. So this shows that their growth isn't just empty calories, it's actually profitable.
So if they raise all this cash from the IPO, what are they going to do with it? Well, the plan is pretty standard stuff for a growing company. They're looking to strengthen their balance sheet by paying down some debt, and then fuel their day-to-day operations by beefing up their working capital. No big surprises here.
All right, let's get real. No investment is perfect, right? You've always got your pros and your cons. So let's weigh the good against the bad and get a balanced look at this whole opportunity.
So here it is, the central trade-off. On one side of the scale, you have that impressive revenue growth and the perceived safety that comes with government contracts. But, and this is a big but, on the other side, that stability has a price. Government clients can be slow to pay, which puts a real strain on your cash flow. You add to that a business with no unique product of its own and the low trading volume you expect from an SME stock, and suddenly the risk side of that scale starts to look pretty heavy.
So what's the early buzz? How's the market pricing this thing? Well, the valuation itself seems reasonable. It's not a screaming bargain, but it's not wildly expensive either. But the really interesting clue is the gray market premium, that unofficial price before it even lists. And right now, it's pretty flat, pretty quiet. That's a little signal that the market isn't expecting some huge price pop right at the opening bell.
So we've looked at the numbers, the business, the pros, the cons. The big question now is this IPO right for you? Let's break down who might be a good fit and who might want to pass.
So this might be a good fit for your portfolio if you're okay with the roller coaster ride that the SME market can sometimes be, if you're specifically looking to get a piece of the growing tech infrastructure space, and, this is key, you're in it for the medium to long haul, not just a quick trade.
On the other hand, you might want to sit this one out if you're hunting for a quick day one profit. That neutral gray market premium is a bit of a warning sign there. Also, if you really prefer the safety of big tech companies with their own bulletproof products, or if you absolutely need to be able to get in and out of a stock easily, this probably isn't the one for you.
So at the end of the day, it really all boils down to this one final question you have to ask yourself. For your portfolio, does the stability of that government business, which can be slow and steady, outweigh the very real liquidity risks of an SME stock? Is that trade-off worth it for you? That's the core calculation you've got to make.